As we head into the new trading week, the market is currently closed for the weekend. The last print for Vivakor Inc., ticker VIVK, was a closing price of $0.2313 on Friday, October 31st, 2025. That was a small gain on the day of just over 1%, but that single number hides what was an incredibly volatile session and a truly chaotic week for the company. On Friday alone, we saw the stock open higher at $0.24, spike to nearly $0.25, and then crash down to $0.21 before finding its footing. This all happened on massive volume of over 22 million shares, which is exceptionally high for a stock at this price level. Now, many investors might be looking at Vivakor, seeing a flurry of press releases about new contracts and dividends, and thinking this is a ground floor opportunity. The expectation is that this is a company on the verge of a major turnaround, but the reality of why this stock is pinned below 25 cents is far more complex and, frankly, far more concerning. The stock isn't just treading water, it's fighting against a powerful anchor of massive, ongoing shareholder dilution and a ticking clock from the Nasdaq exchange itself. The story here isn't just about the company's new business, it's about its desperate fight for survival. Let's first establish the common ground, the bull case that is drawing so much attention. If you've been following VIVK, you know the company has been extremely busy. Just last week, they announced their new commodities trading arm, Vivakor Supply and Trading, has executed its first major transaction, a $24 million crude oil deal. This followed an earlier announcement that they had secured a $40 million credit facility to back this new trading platform. On top of that, the company put out a press release on Friday stating it was resetting the payment date for a special dividend to December 31st. So you have a new, potentially massive revenue stream coming online, and you have the promise of a dividend. This is the narrative that many are clinging to. But this is where we have to challenge that narrative with the hard facts from their own SEC filings. The reality is that Vivakor is funding its operations by selling its own stock, and doing so at an alarming rate. On October 30th, the same day as the exciting $24 million contract news, the company also announced a $2.7 million registered direct offering. This means they sold 13 million new shares of common stock, plus warrants for another 2 million shares to an institutional investor. This is what is known as dilution, and it's not a small amount. Over the past year, Vivakor's total number of outstanding shares has grown by a staggering 155.7%. Just days before that, an 8K filing showed a lender converted $400,000 of debt into another 3.9 million shares. So for every piece of good news that comes out, the company is simultaneously increasing the supply of its stock, which puts immense downward pressure on the price. You can't expect the stock to fly when the company is dumping millions of new shares into the market. This brings us to the most critical risk facing every current and potential shareholder: the Nasdaq delisting notice. Vivakor is officially non-compliant with the Nasdaq minimum bid price requirement because its stock has traded below $1 for too long. They were first notified back in March 2025. On September 17th, Nasdaq granted them a 180-day extension to fix this. That new deadline is March 16th, 2026. To regain compliance, the stock must close at or above $1 per share for at least 10 consecutive business days. If they fail, they will be delisted from the Nasdaq and the stock will be relegated to the over-the-counter or OTC markets, where liquidity dries up and many institutions are forbidden from investing. The company has already stated in its filings that it may have to perform a reverse stock split to cure this. A reverse split is a cosmetic fix. It doesn't create any value. It just bundles, say, 20 shares into one new share to get the price above $1. Historically, these are often very bearish events for retail holders, as the stock price frequently resumes its downward trend after the split. Now let's talk about the short sellers. When you see a stock with this much conflicting news, you have to ask what the smart is doing. We've seen some chatter on platforms like StockTwits and Reddit, with bulls pointing to the new contracts and bears screaming about the dilution. But the data tells the real story. The official short interest, according to Nasdaq data, is about 1.25 million shares, which is only about 2.5% of the float. That number seems low, almost insignificant, but it is completely misleading. The real story is not the amount of shares being shorted, it's the cost to short them. The short borrow fee rate for VIVK, as of the end of last week, was an astronomical 84.35%. Let that sink in. Short sellers are paying an 84% annualized fee just to hold their bet that this stock will go down. This is not a cheap gamble. This is an extremely high conviction bet. Why would they pay so much? Because their thesis is simple. They are betting that the dilution will continue, that the company will fail to become profitable, and that it will ultimately fail to meet the NASDAQ compliance deadline. They are betting on the reverse split or delisting. This isn't some vast conspiracy. It's a financial calculation based on the company's own filings and precarious financial health. For those of you looking to protect yourselves, this is what you need to track. You can find short borrow fee rates on financial data sites like Fintel or Ortex. When this rate is high, it means shares are scarce and demand to short them is intense. It's a massive red flag. Another signal to watch is the off-exchange short volume. For VIVK, this ratio has been consistently over 50% for the past week. This means a large portion of the shorting activity is happening in dark pools or off the main public exchanges. What's your take on that 84% borrow feed? Is that smart betting on the delisting, or are they underestimating the new trading arm? So what does Vivakor actually do beyond this new trading arm? The company has historically operated in two segments. First is transportation and logistics, where they own a fleet of trucks and a pipeline for moving crude oil and water in major U.S. basins. Second is terminal and storage services. This is their traditional asset-heavy business. They also have a promising green angle with their remediation technology, which is designed to process and clean oil field waste and sludge, recovering usable petroleum products. This is a great story, but the financials show this side of the business has not been enough to offset the company's significant cash burn. The latest reports show a negative earnings per share of over $1 and a net profit margin of negative 33%. This is why they've had to pivot to the new commodities trading business and raise so much cash. Looking at who owns this company is also revealing. Institutional ownership is very low, at just over 8%. In fact, recent filings show major players like Citadel and UBS Group have been reducing or eliminating their positions. That is not a vote of confidence. However, insider ownership is incredibly high at over 45%. The CEO himself, James Ballengee, owns nearly 38% of the company. This can be a double-edged sword. On one hand, you could say his interests are aligned with shareholders. On the other hand, with such a controlling stake in a company that is engaging in such heavy dilution and complex financing, it's difficult to know who is truly benefiting from these moves. So as we look to the future, we have two very clear and opposing scenarios. The bull case rests entirely on the new commodity trading business. If this $24 million transaction is the first of many, and if that $40 million credit line allows them to scale this into a profitable high-volume business, it could generate enough revenue to finally stop the dilution, satisfy the company's cash needs, and get the stock price back over $1 naturally. In this scenario, the 84% borrow fee paid by shorters would backfire, and we could see a significant squeeze. The bear case is unfortunately supported by the company's own history. The bear case is that the trading business is not enough, that the company will continue to burn cash, that it will be forced to dilute shareholders even more at progressively lower prices, and that it will ultimately be forced into a reverse stock split to avoid delisting. In this scenario, the stock price will continue to fall, and the short sellers with their 84% borrow fee bet will be proven correct. The next major catalyst to watch will be the company's next earnings report expected around November 25th. This is where we must see, in black and white, if this new trading revenue is real, if it's profitable, and if it's enough to change the company's trajectory. Before then, any new 8K filing announcing more dilution or any news on the remediation technology front could swing the stock wildly. Comment below if you think Vivakor will manage to regain NASDAQ compliance before the March 2026 deadline, or if a reverse split is unavoidable. In the end, the story of Vivakor is a perfect example of expectation versus reality. The expectation, fueled by press releases, is that of a multifaceted energy company with a new exciting trading arm and a green tech angle. The reality, found in the SEC filings, is that of a company in a precarious financial position, fighting for its life on the NASDAQ and funding itself by massively diluting the very shareholders who believe in its story. The recent volatility and high volume show that this battle between the bull narrative and the financial reality is coming to a head.